The IMF stood up and said, the world economy is hitting into the worst economic headwinds since World War II, the worst. And that's why it could be bad news, but depending on how you look at it, it could be very good news.
This is about as macro an environment as I've ever seen. And I think most people's read on it is probably wrong right now. So, okay, let's go back and say, I'm going to take you through a history lesson.
Good.
And then we'll get to today.
That's
and
macro.
I'll tell you why I'm concerned.
Yeah.
So why World War II? World War II was a fascinating period because, like COVID, the entire world had basically been stuck at home or been on battlefields. Everyone came back. There was no supply of commodities and goods. Global supply chains were broken and everybody came back and started consuming again. And guess what? Inflation went up to 13% or something, maybe even higher. And that period was fascinating because interest rates went up and the first thing that happened was the economy went straight back into recession and inflation went negative because it was a massive tightening of monetary conditions. You raised the cost of goods on people and didn't raise their salaries enough. People couldn't get the goods that they wanted, exactly like now, and everything collapsed. So we went back into recession and then eventually some better times. And I'll come back into the 1940s and 50s because I think it's a really important parallel that most people misunderstand. The next time we saw anything remotely like this was 1974. A lot of people tell you it's the 70s again, inflation. Well, the inflation episode we had in the late 70s was driven by demographics. That was the baby boomers entering the workforce all at the same time. It was the largest demand shock the world had ever seen. And we had a supply shock of this oil crisis of the Arab oil embargo. That's not repeating now. What is actually more similar is 1974. 1974 was the Arab oil embargo. The price of oil tripled and interest rates went up. Inflation shot up and the immediate effect was the economy went down the toilet. Almost do not pass go. The stock market fell 50%. And the ISM survey, which is a good guide to the business cycle, it's the Institute of Supply Managers survey. Anytime it crosses below 50, suggests the economy is getting weak. A recession comes at about 47. It hit 30, which was the lowest in all history. And it happened in a space of 4 months. It went from roughly where it is today, which is around 55.
So are you saying that the 70s and now are pretty close?
Yes, and inflation fell in 1974 afterwards. People are still thinking inflation goes on forever. It did not, and it did not in the 1940s either. Then the next one up is 1984. 1984, we saw an issue where global trade, there was a huge amount of trade disputes. The dollar was pretty strong, like it is now. Interest rates were going up, and inflation was high. And everybody was fearing, looking back and saying, oh, we don't want the early 80s, late 70s again, the inflation. So Volcker was tightening rates too much, and the economy collapsed. It didn't go to recession because the Fed quickly started cutting rates, but the dollar went up a lot more and created a lot more problems. We ended up with the Plaza Accord in 1985 when everybody had to stop the dollar going up from destroying the global economy. Right. So then the next time we see something similar was 2008. 2008, if you remember, the oil price was at $147. Inflation was 6%. The Fed had been cutting into that because the economy was imploding. 2018, exactly the same. Oil prices high, inflation high, the Fed were hiking rates, trying to tighten the balance sheet, and what happened is the economy rolled over really quickly again. Mortgage rates have never risen this fast. So any money you borrowed has suddenly got much more expensive. Your wages haven't kept up with the cost of just basic services like food. So you're actually feeling poorer, so you can't consume as much, and you start not consuming other things. People overextended on housing because they rushed into housing in 2020 and 2021, and the rates have gone up for them. Also, just the rise in things like the cost of oil has meant that, gas prices, all of this stuff, and then the rise in the dollar, which is a monetary tightening. All of these things get together would suggest, and I put them on a chart, it suggests that the ISM is going back to 30, which is as it was in 1974, which is a terrifying fall. And it's suggesting that if we're not careful, we could have a very sharp, nasty recession, meaning kind of a negative 5% GDP recession. It might be short, depending what the Fed does, and we'll come on to that in a bit. So we've got the setup that we've seen many times in the past. We've got the forward-looking indicators, this monetary tightening, suggesting we've got some real pain to come. Then the anecdotal evidence, we're seeing all the tech companies who were bulletproof laying off staff and giving earnings warnings because everybody can't raise prices enough, so their margins are falling and people have overextended. Amazon said, we've hired too many people. They're one of the biggest employers in the United States. The monetary conditions that we've imposed on corporates and people is the biggest tightening in all history.
Wow.
We've also got China slowing down very fast because the lockdowns, but also they've been in recession. So we've got and Europe with a war and having to deal with this energy transition. So we've got no leg of global growth here.
Oh.
Now the question is how bad does this get? So let's talk some scenarios.
May I ask a real quick question? Okay, when people use the word recession, that means 2 back-to-back quarters of negative growth. Is that your definition?
That's the technical definition of a recession, the Fed balance sheet. The Fed balance sheet disguises all bad things because what it does is when they print money, it lowers the purchasing power of the dollar. And most of the central banks at the same time do it. And people always think it's going to be inflation is what it leads to. It leads to something much more pernicious and evil, which is the debasement of currency. And what that does, how it manifests itself, is all of these scarce assets, equities, real estate, gold, crypto, go up a lot. But all they're doing is reflecting the devaluation of the fiat currency itself. So that optically can change everything because suddenly all of these things go up, everybody feels okay, and it changes the outcome. People are still worse off generally, but it's a trick. And so I think that trick gets played again pretty soon. This time I think the trick gets played in a different way, which was the other genie that came out of the bottle in 2020, which the Europeans are doing now, some states in the US are doing, Japan is doing, and a few other countries, which is India is doing, which is direct transfer payments to individuals. So as opposed to making a big fiscal stimulus, like we're going to cut taxes.
So can you go into what you're seeing coming down the road?
I think it's going to happen at a shocking speed. So 1974, we went from everything looks okay to the worst recession since World War II in 4 months. I'm thinking it's going to look similar because of the speed of the monetary tightening, the speed of the rise of prices. So I think we are going to have a very ugly few months, both economically and for markets. The question is what comes next? And that's the key point. If my base case comes into play, which is the Fed pivot, they stop raising rates, they already started suggesting maybe we'll pause in September. My guess is June will be the last hike. And after that, they will say, well, we're just going to see, and we'll see the economy start going down the toilet. And they will start thinking, well, we're not going to do QT now either. So they're not going to start shrinking the Fed balance sheet. And before you know it, we're going to be talking about rate cuts, but we don't have many rates to cut, rates are nowhere. So the only outcome is they're going to have to print money. The credit markets are already starting to dry up. That's usually an indicator. The housing market's rolling over. That's a bad indicator. Real rates, meaning you in the property market, are going to make a lot of money. So negative real rates become very good for assets. And what happened in the 1940s and 50s was a massive economic boom. What we actually got was the value of the war debt eroding because of this financial repression. We had the value of assets like housing. The equity market went up 900% over that period of time. There was a lot of fiscal stimulus because you had to rebuild after the war and companies were building factories. So if you think of now, companies are going to be rebuilding factories in the United States or in Europe and not in China. So that's going to add some stimulus. Yes, the jobs are not there. It's robots in the factories, but it's still stimulus for the economy. The government will do some stimulus as we've talked about. Interest rates will remain relatively low. Inflation will remain controllable, but a little bit higher than it has been. And what that sets off is a period of stability and boom because there's so much technology. Best trade in the world at this phase, the next 2 to 3 months. At the end of this phase, I think the Fed come with their cannons again. Whether it happens quickly or in 3 or 6 months' time, it's coming and the markets will start to the Pavlovian response of the cavalry's coming. And then I think it's very positive for things like cryptocurrency, probably gold and a few other things. Real estate, I think, is going to take a while, but I don't think it's probably a big event. It got very frothy. It probably corrects somewhat. But again, I don't think the Fed or anybody else wants to see the property market go down because everyone's got the learnings from 2008. So yes, it softens a bit, etc. I think it's okay, and you'll probably get some bargains.
Well, final words is I hope people have been preparing because, as he also said, the person with the cash in a recession is the king. But if you don't know what to do with that cash, you're going to just sit on cash. So this could be the greatest opportunity. It's going to be, and everybody, so many guests we've had on our show say we are in for a rough ride, and we were certainly going to be in for a rough ride. It's not going to be pretty, but it doesn't have to be that rough if you've got a little bit of financial intelligence.
Yeah, there's going to be more opportunities floating to the surface as well as bodies floating to the surface.